Welcome to Managerial Accounting for the Fall 2022 semester. Today is day 19. So we are now in week 10 of 15 for the semester, almost 67% of the way through the class. Today we're going to be finishing up chapter 23. We'll pick up with exercise 6. That's one that I asked you to try on your own after class on Tuesday because it was a combination of direct materials and direct labor variance. And so that was a good way for you to practice on your own with those two calculations. And so we'll pick up with that exercise today. We'll finish up the rest of the exercises. And so the chapter 23 exercises should be submitted for grading by the end of the day today. Then, of course, the chapter 23 problem will be due our next class day, which is Tuesday, November 1st, and we'll start chapter 24 at that time as well. One thing that you can't see in these due dates or in the course calendar, but I did include in the announcement after Tuesday's class. If you look at the syllabus, pull that up here. If you look at the due dates on the syllabus, you'll notice that the annual report actually has 4 separate due dates. And the third one of those is next Tuesday. So that would be November 1st. The reason it doesn't show up in the course schedule is because this is an optional due date. But I said in the announcement on Tuesday that we would talk about that during class today. And so we're going to talk about that. And the due date that actually shows up in the course schedule is this one, which is the actual due date of November 8th for that annual report project. So let's go to the annual report project and spend just a couple minutes talking about that. At this point, you've done step 1, which is choosing a company. Everyone has had your company approved or had one assigned to you. If you don't know what company you chose for the project, you should be able to just go to this discussion board and find that. If you had one assigned to you, that would have been assigned by email. But again, if you can't find that, you can ask me. I have them all written on my in my records. And so I will be happy to tell you what your company is if it's not located here on the discussion board. You then should have a couple weeks ago submitted your sources for the project. And that was intended to be 3 separate sources. One is the company's website, but then 2 outside sources that are about your company and or the industry in which they operate. And so that also should already be done. Choosing a company and having it approved is the first 5% or 5 points of the 100 for the project. Then the step 2 is worth 15 points. That's 5 points for each of your 3 sources. And as I told you at that time, you aren't limited to just those sources. If you find additional sources or better sources, you are welcome to use them. You're not tied to only using the 3 that you had identified a couple weeks ago. What's due officially on November 8th, but I said there's that optional due date next Tuesday, November 1st, is the actual completed project. And the note here on the Dropbox explains what that is. That option of submitting 1 week early is to give me a chance to review your project and let you know, here's what your grade would be if this is your final project. And here's what's missing, or here's where you aren't getting full credit. And so I actually grade that draft submission as if it were your final report. And I give you your actual grade. If this is your final report, and the total for step 3 is out of 80 points. And so I would tell you, your grade is 78 out of 80, and here's what's missing. You can then make an informed decision about, is it worth it? Let's say your grade is a 78, you're missing 2 points. You can decide, how long is it going to take me to pick up these extra 2 points? Is it really worth it? So you can do what I keep talking about in this class, which is that cost benefit analysis. Is it worth it to get those extra couple points? In order to submit a draft by next Tuesday, it needs to be a completed draft. You have to actually believe this is a finished product that I'm turning in. Please do not turn one in that's half done, because you know it's half done. When I look at it, I will know it's half done, but we will both be wasting our time to review something so that I can tell you what's missing when you already know what's missing, because you know you didn't follow all the directions for the project. So please do not submit it. If it's half done and I see it's half done, I'm just going to tell you this is not a finished draft. So I would encourage you to take advantage of this option to turn in the draft. Depending on how many people actually submit drafts, it does take me some time to get through them, because grading a completed project takes a bit of time. But once I get feedback to you, you will then have a reasonable amount of time to submit your final or updated project if you choose to do that. Some people who submit a draft are going to see their grade, maybe it's 78 or 80 out of 80, and say, I'm happy with that. And you don't have to do anything else at that point. But if you submit a draft by November 1st, the end of the day, I will review it, get feedback to you, and you can then have a reasonable amount of time, excuse me, to make any changes you want and then resubmit. So any questions about that? Any questions about the actual project itself at this point? Some of you are probably already working on them. Some of you may not have really done anything since you found your sources. If you want to take advantage of this draft, regardless of where you are in the actual report process, you still have 5 days to do that. But it does need to be a complete, what you believe honestly to be a completed project. And remember, there are some sample projects here. So if you are just getting started on it and you're not even sure what I'm looking for, what it should look like, there are 3 samples in here. 2 of them are several years old at this point. One of them is a little bit newer, like maybe a year ago. So you're welcome to take, yeah. Oh, good to know. So I will make a note, because this is probably one of those things that didn't copy over. I bet they're in the online class, because that's, for some reason, you may recall from the beginning of the semester that I copied from Blackboard into Brightspace for the online class, and then I copied within Brightspace for this class. And for some reason, stuff copied from Blackboard, but then did not copy within Brightspace, which just strikes me as really weird. But thank you for telling me that. And right after class today, I will fix those. So it actually says there's a document and it's not, huh? Huh, okay. Yeah, so I imagine, I'm just gonna check. They're probably in the other class, which doesn't help you at all. And I will fix that after class, but I just want to check. Yeah, so it's bizarre. So sample projects, let me make myself a note, and right after class today, when I get back to my office, I will fix those so that they are there for you to review. The whole idea is that you can see these are projects that were submitted by students in the previous semester, but the project was identical to what it is now. And it just gives you a sample of what I'm looking for. So all of those were projects done by other students that received very high marks, whether it was a 78, 79, 80. They were very well done projects, and each one of them is different. And so you can see they approach things differently, they organize things differently. I would prefer, for the most part, that you organize things the same way they're organized in the instructions, because it just makes it cleaner for me to identify on the rubric that yes, you included that information. So it makes the grading cleaner, makes it less likely that I will miss something, not give you credit for something that you actually included. Of course, if that happened, you just want to bring that to my attention. But, so the instructions are here. The formula sheet is here to do the final next to last part, the financial analysis part of the project, which is 30 out of the 80 points. So that's obviously a big part of it. There are Excel templates here. Did that come over? Yeah, so that's there. There are Excel templates here that you may choose to use. If you choose to use those Excel templates for doing your financial analysis calculations, please just either include that Excel workbook as a second attachment when you submit, or what some people like to do is just copy the individual tables out of the Excel workbook and paste them right into your project. Either one of those is fine. And you'll see at least one of those sample projects did that, copied and pasted the templates. So you're welcome to do that, whatever is your comfort level to make that happen. I need all the information. If it's in 2 separate files, if you want to do the calculations in the Excel spreadsheet and then just talk about them in the Word document that you're preparing for the project, that's fine. I'll point out a couple of things about the actual instructions for the project. Specifically, let me just make a couple comments. So the introduction part, you're welcome to bullet point, just like you see here. It does not have to be narrative form. It can be really, I don't know, not well written, kind of boring to read if you say. Yeah, so you would just say, you know, CEO, Mark Smith, home office, address, you know, Seattle, Washington, or whatever. Don't just bullet point, don't just say bullet point Mark Smith. Well, I don't know what you're saying about Mark Smith, but you can imagine what it would be like to read 30 or so of these projects that say the name of the CEO is Mark Smith. The location of the home office is Pleasantville, New York, whatever. Please try to make it clean and not and well written, but it's okay to use bullet points as appropriate for that type of organization of information. Make sure you answer each question fully. Royce, did you have a question?
Yeah, so number 3 is basically
Number 3.
like on here for the term project. That's the next step for you.
That's what you're doing right now. Yep. So step number 3 is this number 3 item here. It's the entire project. Yep. Yep. So you've already done 1, which is choosing a company, 2, which is giving me your sources. And now you're doing part 3, which is the final part. For industry situation and company plans, that's worth something like 10 points out of the 80. So 1 or 2 sentences is not a 10-point answer. You should have a legitimate amount of information there telling me about what's going on in the industry and what your company is planning to do. You can get some of that information, excuse me, from your company's annual report, but don't just copy and paste 3 paragraphs or 1 paragraph out of your annual report and think that that's a 10-point answer. Again, for the financial statements, there are several questions in each of, so there's 3 parts. One about each one of those 3 financial statements, and within each one of those, there are several questions to be answered. Make sure you answer all of them, because each one of those questions is worth a set amount of points in my rubric. Accounting policies, this is accounting class, and so this should be an important step in this project. I believe that this is worth 6 points in my revised rubric, and it tells you specifically the accounting policies that you're trying to find. Where are you going to find them? You're going to be in your company's annual report. You're going to go toward the end. It's usually about 2/3 of the way through or 3/4 even of the way through the annual report before you get to the actual financial statements that look just like what you learned to prepare in financial accounting. So you'll see the income statement, the balance sheet, stockholders' equity, and the cash flow statement. Immediately following the cash flow statement, which is usually the fourth one that's presented, whichever one is the last one that's presented, immediately following that, you'll find the notes to those financial statements, which is the detail that speaks to, that gives more information about what's in those financial statements. Usually the first note, but sometimes it's the second. I don't think I've ever seen where it was not the first or second note. Immediately following the financial statements is you'll see it's called significant accounting policies, and it's almost always called exactly that. It's the first or second note to the financial statements, and it's titled significant accounting policies. And within that, and it might run for several pages, you don't need to copy and paste the whole thing, but you're looking for policies related to each one of these items that's listed here: revenue recognition, cash, short-term investments, merchandise inventories, property and equipment. You can copy and paste if it's not pages long. You should only be including the policies about those particular topics unless you see something that you just think is really cool and interesting. And you need to speak to you should be speaking only to those, and copying and pasting or quoting is fine, but don't give me a whole bunch of, don't make your paper 20 pages long, copying and pasting a bunch of stuff that's not relevant. Section E here is the biggest section in terms of points. It's also the one that's going to take you the most time probably. This is where you'll find those Excel templates helpful to assist in formatting the calculations here. What I want you to notice specifically is it says for the past 2 years. So if you only give me 1 year of results, you're not getting full credit for that. It says to calculate them. So that's where the Excel template can come in handy if you choose to use it. And then it says to discuss the significance of. And so if you just hand me 2 years of ratios, but don't tell me what does this mean, again, you're not going to get full credit. Within my rubric, within my grading scheme, each one of those pieces, 2 years, calculation, discussion, each one of those has its own point value attached to it. So you're going to calculate each one of these items for 2 years. And then what I would recommend is, rather than just telling me, for example, working capital increased or working capital decreased, that's not the significance of it. So what I would recommend is that you take each one of these 5 areas: liquidity, profitability, long-term solvency, and cash flow adequacy, then market strength. So is that 6? No, it's 5. That's what I thought. So there are 5 separate areas that you are doing calculations that are going to help you answer that question. And what I would recommend is for the discuss the significance of, for each one of those 5 areas, starting with liquidity, you say, this company's liquidity, just as an example, this company's liquidity has improved since last year. Here's why I say that: because their current ratio increased, their receivables turnover increased. But on the other hand, their days inventory on hand also increased, and that's not good for liquidity. So what you're telling me, what you're showing me by what you write, is that you understand what these ratios mean. You understand whether increasing or decreasing is a good thing. And that you can analyze or assess for the company that you chose for your project, how are they doing in these areas based on my calculations, based on this year's results compared to last year's. And so as you look at the sample projects, what you'll see is maybe all 3 of the projects show the answers, the results for each of the 2 years, and then have a little paragraph, few sentences, maybe several sentences about how are they doing with liquidity. Then they show the profitability results and they say, how are they doing with profitability? Does that make sense? So just telling me working capital increased, operating cycle decreased, that doesn't tell me that you know what that means. So this is a really important part, because honestly, a lot of these calculations, not all of them, but a lot of them you can find right online. And if you want to do that, let me just show you. Oops. So if you go to Yahoo Finance website and you just put in the name of your company, and I'll just go with Meta, which is Facebook. I'm sure you all know that. If you look at the analysis tab here, you can see that some of the calculations are already done for you. There are more somewhere else as well. I don't know where it is. It's easy to find. I should say that as I'm having trouble finding it. There are existing calculations. Just not putting my fingers on them. Maybe they're back here on the summary. You've got some of the calculations here, earnings per share, although that's the trailing, TTM means trailing 12 months. So that is not for the fiscal year. That's starting from today, count back 12 months. This is the result. There are other websites that show more calculations like that. Dividends yield is something. So Facebook doesn't, or Meta doesn't pay dividends. You can tell that right here with the NA. PE ratio is another thing you have to calculate. What I'm saying is, if you find a website that has some or all of these calculations done for you, it's okay to use those calculations that you found. Just make sure you cite your source. So you either need to cite the source or show me your calculations. So those are your two options: cite your source or show me the calculation. What I would warn you against is spending an hour and a half trying to find the calculations already done when it would have only taken you an hour to do them on your own. And I've had people tell me that they've done that. I spent X number of hours trying to find them. Well, that's not an efficient use of your time, because honestly, it just doesn't take us that long to do the calculations yourself. Another note about that, when you see things like calculations like receivables turnover that requires you to calculate the average receivable, or inventory turnover that requires you to calculate average inventory, for the earlier year, because you're doing these calculations for 2 years, for the earlier year, if your company only shows 2 years of receivable, or column 2 years worth of data on their balance sheet, you might need to pull up last year's annual report to get the beginning balance for that older year. If they show 3 years, you're good. If they only show 2 years, to find the average, you'll need to access last year's annual report as well. So that's where you'd find that. Okay. So that's all I really needed to say about the annual report project.
When you say the past 2 years, is it like 2022 and 2021 or 2021?
Yeah, so that's a good question. So the question is, which 2 years are we using? And the answer is, it depends on when your company finishes their fiscal year. So a company that finished their fiscal year, say at the end of June of 2022, you're going to, those will already be audited. We're now in the end of October. So June year-end dates, those would already be audited, would already be published, and you're going to find that annual report as their most recent annual report. But a company that just ended their fiscal year, say at the end of September, those companies' annual reports have not yet been audited and aren't yet available to the public. And so for that company, you'd have the year ended September 2021 and the year ended September 2020. So it's going to be the most recent 2 years for your company. And if you look at any company's website, if you look at any company's website, let me just, whoops, I can't spell. 11. Any company's website is going to have, if they're publicly traded, they're going to have a section that's for investors. And usually it is called investors or investor information or shareholder information, just like that. And so I just picked randomly, I picked General Electric. You can see events and reports here. You can see a link there for annual report. For GE, their most recent annual report is 2021. And so I'd need to use the 2021 annual report, and then at somewhere down here, probably a link to their 2020 annual report. So there's downloading the 2021. Whoa. And then here I can choose to go to 2020 or any earlier year. So does that answer your question? I can't give you an answer. It's 20. For some companies, you might find the fiscal year that ended in 2022, and for others, you might not. Depends on when they end their annual, when they end their fiscal year. Companies that use a calendar year, you're going to find 2021 in 2020. Okay. Any other questions? So if you choose to do the draft, it needs to be submitted by November 1st to give me time to look them over. If you submit it after November 1st, it's my discretion whether I review that or not. And if you choose not to do the draft, then the full report is due on November 8th, which would be your final submission. If you are doing a draft, the draft goes in the same Dropbox, the step 3 Dropbox. And then if you choose to resubmit, you would submit again in that same Dropbox. And if you choose to just stick with the grade that you received on the draft, it's already in the grade book where it belongs. If you resubmit and your grade goes up, the new grade will just be substituted in for the older grade, for the draft grade. Okay. So we spent quite a bit of time talking about that. Hopefully that clears up any questions you might have had, but if you do run into anything else, I will be happy to answer questions on that. If you're planning to do the draft, don't wait for Tuesday to ask me the question. And if you have a question this weekend as you're working on it or whatever, just send me an email so I can get back to you and you can keep working. I do not recommend at all that you print out your company's annual report. They're dozens to hundreds of pages long. If you feel the need to print anything, the only parts I would consider printing if I were working on this project is the actual financial statements, the 4 or so pages that are the actual income statement, balance sheet, and so on. Those might be handy to be printed out so that you can easily pull numbers from there and plug numbers into the Excel template if you're using that to do your calculations. The rest of it, a lot of it you have no need to even read for this project. I don't encourage you to read 120 pages of stuff that's not going to be helpful for the project. If you have trouble finding something that you know you need, you should just ask and I'll be happy to help you.
So the income statement is going to be found in the annual report.
Yeah, and it's usually about 2/3 to 3/4 of the way through that you'll find those financial statements. Yeah, so what you're looking at on your screen is a whole bunch of words. I would even use the scroll bar over, and just look for a page that it turns to what appears to be a chart. And then click on that. Yeah, that's not it. And most financial statements, most annual reports have some summary charts earlier on that are nice and pretty, and they might even be, colored and, glossy. They're trying to point something out. Yeah, there you go. So those are they. And right after those is where you'd find the notes to the financial statements. So just out of curiosity, how many pages long is that document you have up there?
8.
Okay, so the one he's looking at in the classroom is only 82 pages long, but out of those pages, you might need 20, maybe, to work on the project, maybe not even that much. There's just a ton of information in there that's not needed for this report. There's probably a great deal of information in there that won't even make sense to you. And it's totally unnecessary for the purposes of what we're doing here. The idea of this report is that it's applied learning, looking at what a real live company does to apply what you're learning in this class and what you already learned in financial accounting, so that you can understand how decision makers might use this information to make decisions about a company, the types of financial analysis they would do, the types of information that is reported or disclosed in the annual reports. All of them follow roughly the same format. And that's why I can make blanket statements like the financial statements are usually 2/3 to 3/4 of the way through, because most companies follow that same kind of format because they want their financial statements to be usable. They want people who are doing a comparison between two companies to be looking at roughly the same kind of information in those annual reports. Plus, there are rules about what has to be in there. So, any other questions at this point about the project? So it is a major part of your grade, something along the lines of 15%. Yeah, so the annual report makes up 15% of your final grade. Definitely not something you want to skip over.
50.
But no, 15, sorry, 15%. And that's right on the front page of your syllabus. So exams make up half of your grade. Pre-quizzes and exercises make up 10% each. And then the chapter problems in the annual report make up 15% each. That's the 100% for your grade. So for one assignment, it's a pretty big chunk. It's actually worth more than a full exam grade when you take into account all 3 steps. Each exam is worth 12.5% of your grade. The project is worth 15% altogether.
So we're gonna have 2 different answers for like working capital.
Yeah, because you'll have one for 2022 and 2021, or whatever 2 years you're using. Okay, so I'm going to stop there unless there are any other questions, and we'll get back to our chapter for today. Okay, so let's go directly to chapter 23. And as I said, we're going to pick up with exercise 6. This is the one that I asked you to complete on your own outside of class to make sure that you were okay with applying what we learned in class last time. So I'm going to go through this pretty quickly so that you can, I assume if you've done this, you've already checked your work using the check my work button. There also is a show me how button up there that you may have found useful if you needed more guidance for how to do this. So you're asked to calculate the direct materials quantity variance first. And so the calculation for that, we first need to know the standard direct materials quantity. So we can see direct materials of $50,000, and that was for 5,000 toys. And let's see, what else do we know here? So they actually produced 4,850 units. Get my annotate button up here. So $50,000 for 5,000 action toys works out to be $10 per toy. Whoops. And the standard materials price is $4 per pound. Whoops. $4 per pound. So if it's $10 per toy and $4 per pound, it must be, just doing that math, 2.5 pounds per toy. So that's the standard units for each toy. Everyone okay with where that came from? Our actual direct materials cost was $49,600, and that was for 4,850 toys, units. And so that worked out to be $10.20, I'm just rounding off, 23 cents per toy. So that's our actual. We expected to spend $10 per toy. We actually spent $10.23 per toy. So we know that the direct materials quantity variance is going to be unfavorable. Choose this down here. It's going to be unfavorable. It cost us more per toy than we had anticipated. So how do we know the dollar amount though? Well, we need to use the formula that we learned. Whoops. Remove this. There we go. The formula that we learned last class for calculating. Let's get my annotate function back up here. And I'm just going to plug it in here in the middle of the screen. So our standard our standard cost for these toys should have been 4,850 toys at $10 per toy. We should have spent $48,500 on those toys. We actually spent $49,600. That's right here in the middle of the screen. So we already knew it was an unfavorable variance, and the variance is 49,600 minus 48,500, which is $1,900. We know it's unfavorable because they spent $10.23 per toy, and we expected to spend only $10 per toy. So that's a $1,900 unfavorable, and we're entering unfavorable variances as a positive number. I always like to check that because to me it's counterintuitive. Seems like if it's an unfavorable variance, it should be negative. Okay, so that was the first thing we were asked to calculate. Everyone okay with that? With that one? So I'm going to clear that information so I have room for my next calculations. And the other quantity we were asked to find was the direct labor time variance. So to do similar calculations so that we can kind of ballpark this, we expected to spend $36,000 in direct labor. Again, that was for 5,000 toys. Yes. Which one's wrong? The 1900? Did I subtract wrong? Yeah, what did I have? 49,648.5. That's what I had on there, didn't I? So I just did the math wrong. So I had 49,600 here, and I had 48,500. I just totally blew the math. So the numbers we had were correct, but I just didn't do the math right. Everybody, so you're okay with that? Okay, sorry about that. Thank you for catching that. I should always use my calculator because when I'm trying to type on the screen and do math in my head, and sometimes it just doesn't work out. I get distracted. So let's go back to the direct labor. $36,000 we expected to spend on direct labor for 5,000 toys. That's an expected cost of $7.20 per toy. And our standard direct labor rate is $18 per hour. So if we take that $7.20 per toy and divide that into the $18 per hour, we get an expected use of 0.4 hours per toy. Excuse me. We expect each toy that we produce to take 0.4 hours. So how long did it take? Let's go down here. Our actual direct labor, $34,020, and that was for 4,850 toys. And so while we expected to spend $7.20 per toy on direct labor, we actually only spent $7.01. So we know that this is going to be a favorable variance, a favorable variance. Let's see what it tells us. So it tells us there was no, right here, there were no direct materials price or direct labor rate variances for June. And so what that means is the standard rate was $18 per hour. We actually paid $18 per hour. So the difference between our expected direct labor and our actual direct labor is completely, fully because of the direct labor time variance. So, whoops, I annotate back up here. And so when we made the 4,850 toys, and we expected each one of them to cost $7.20 for direct labor, 4,850 toys at $7.20 is $34,920. When we compare that to the actual direct labor of $34,020, and I'll try to get the math right this time, 34,920 minus 34,020, the variance is $900. And we've already established it was favorable. We expected to spend $720 per toy. We actually only spent $701. And so that would be a $900 favorable variance. We're going to show that as a negative. So any questions about that exercise? And I would like you to be able to think about it, look, kind of do an analysis just like I just did here as a preliminary, just to get a sense of, is this going to be a favorable or unfavorable variance? Is this good or bad? And then do the actual calculation. We really like you to be able to see that, you know, right off the top, whether it's favorable or unfavorable. So put my green check marks in there. And before we move on, does anyone have any questions about everything we did last time? Calculating both sources of direct materials variance and the total direct materials variance. For this exercise, the total direct materials variance was 1,100 because we were told there is no price variance. And for direct labor, the 900 was the total direct labor variance because we were told there was no rate variance. So what that means is for the direct materials, we paid per pound $4, exactly what we expected. So it's only a usage variance. And the same thing is true for the direct labor. We paid $18 just like we expected to, but we didn't use as much of the labor as we expected, as we budgeted, or as we have in our standards. Get the drawings off the screen, and if there aren't any questions, I'm just going to keep going. So last class, we talked about direct materials and direct labor, both sources, the price and quantity, and the total. You should be comfortable with those. The first 6 exercises all relate to those. And what we're going to go to next is calculating overhead variances. So overhead variance, as I pointed out to you last time, is going to look a little bit different than what we did with direct materials and direct labor, excuse me. The variable part of factory overhead does look just very similar to direct materials and direct labor. They're based on that flexible budget quantity. But as you know, the fixed overhead doesn't change with a flexible budget. So what fixed means it's going to stay constant within our relevant range. And so the calculation of the fixed overhead variances are going to feel a little bit different than what we have done up to this point. We're going to start with the variable overhead. And so that's going to look, again, very similar to what we have done with the direct materials and direct labor. Our first exercise, or next exercise, exercise 7, is dealing with a flexible overhead budget. So I might as well just show you this. This should look familiar, that we have in the flexible budget, we look at a range of possible production. We can see that we have the cost divided by whether they're variable or fixed. The variable costs are going to increase as our production increases, and the fixed costs remain constant within that relevant operating range. One of the exercises we did together on Tuesday, I pointed out to you, it was a little bit misleading because we had the overhead lumped together, and the implication in that exercise was that all of the overhead would change if our production level changed. And we can see here in this budget that that's not true. We know by definition, the fixed cost should remain constant within our relevant operating range. So let's go to our exercise. And we're going to be looking at preparing a factory overhead cost budget for the production department budget press. Press department. That hyphen threw me off. So we have, as we have in earlier chapters, in this flexible budget, we have 3 different levels of possible production. And the way I described these in the earlier chapter, you may recall, was 22,000 is kind of the best case scenario. 18,000 worst case scenario, and 20,000 is maybe our expected value. So these are kind of the limits we're setting on our relevant operating range. Within this range of 18 to 22,000 direct labor hours, we expect our fixed cost to remain constant, and we expect our variable cost to be linear. That is a constant per unit amount. So let's do the fixed overhead part. We'll get the easy part out of the way first. You can see that our expected value right here is 20,000 hours. These dollar amounts are all based on those 20,000 hours. The fixed costs here then are going to be constant at all of our relevant productive capacity. The 18, 20, and 22 in our budget. Supervisory salaries are going to be 80,000 every time. So, whoops, extra zero there. Depreciation of plant and equipment is going to be 50,000 at all levels because it's a fixed cost. And finally, insurance and property taxes, 32,000 across the board. So our total fixed factory overhead, 162,000. What is going to change though is our variable costs. I want to check something. I think I have, I hope I have in here. No, I don't. Okay. I thought I had the formula in that reference materials folder, but I don't. So let me give you the formula. See, I can show it to you here. There we go. So to calculate each one of the variable costs, we're going to be taking for each category the budgeted rate, so the budgeted total dollar amount, and divide by that expected capacity. So this is the formula that you're going to be using for each one of those categories under the variable costs. Budgeted factory overhead divided by the expected capacity. That's the formula I was thinking I had in the reference materials, but obviously it's not there. So let's take a look at our indirect factory labor. And I'll put this on the screen so that it'll be here when we scroll down. So I'm just going to call it indirect labor. And what I'm doing is calculating the per unit cost. The total in our budget is $180,000, and that's when we expect to work 20,000 hours. And so the cost for indirect labor, 180,000 divided by 20,000 is $9 per unit per hour. We can do the same thing for the power and light. Total budget was $12,000, and that was for 20,000 hours of expected capacity. So that's 60 cents per hour. Whoops, not 60 cents per hour. And finally, the indirect materials, $64,000 in the budget for 20,000 hours. $3.20 per hour. And so now when we come down here, this is one advantage if we were using an Excel template, is we could just put in our formulas and not have to do each one of these calculations independently. But we're not using Excel. So looking first at the indirect factory labor, in the budget, the per unit cost is $9 per hour. And the first column here is for 18,000 hours in the press department. Going across then, $9 per hour. If we work 20,000 hours, the budget would be 180,000, and $9 per hour for 22,000 hours, we would include $198,000 in our variable flexible budget. Everybody make, okay with those? Okay with those? Okay. So now we can do the same calculations for power and light and indirect materials. I'm going to let you try those on your own. We have the per unit costs already up there in the top right hand side of the screen. And once you have those, you can add down the column to get the total factory overhead variable. Add that to the fixed to get the total at the bottom. Any questions on putting together the variable, the flexible budget, how to calculate the variable cost? When we have the static budget based on their expected production, for the variable costs, we first need to convert those into cost per unit so that we can then forecast for the flexible budget. Everybody good there? Let me go back to the PowerPoint then. Get my drawings off the screen. And our next exercise, exercise 8, is going to have us calculating those cost variances. So we know we have to be analyzing the variable factory overhead separately from the fixed factory overhead. And we know that the variable overhead, the variances are going to be based on the flexible budget. The fixed overhead variance is going to look very different though, or somewhat different. Okay, I think we can probably, rather than having you focus on those formulas, let's just go to the exercise and we'll walk through each one of these. And I'll give you the formulas as needed. In general, I would like you to be able to think through it, as I've told you before, rather than relying on just plugging numbers into a formula without really thinking about what those numbers mean. We make that a little bigger. Looked kind of small up front. So this is exercise 8. Exercise 8, yep. Factory overhead cost variances. Thomas Textiles Corporation began November with a budget for 60,000 hours of production in the weaving department. The department has a full capacity of 75,000 hours under normal business conditions. So remember, we've talked about those three different versions of the term capacity. Theoretical capacity is the perfect world where we do not live. For this company then, practical capacity is the 75,000 hours. And their normal capacity, their expected production for this month is 60,000 hours. The budgeted overhead at the planned volumes, which would be the 60,000 hours, at the beginning of November was as follows. And we can see the total there, the budget is $712,500. The actual overhead was $725,000. So we know in total, we have a $12,500 unfavorable variance in our factory overhead because our spend exceeded what we planned to spend. The actual fixed factory overhead was as budgeted. So we actually spent $262,500. During November, the weaving department had standard hours at actual production volume of 64,500. So we had built this budget expecting to work 60,000 hours, but we actually worked 64,500 hours. Why would we have worked those additional hours? Presumably because we had more sales, we had more cause to do more weaving, right? We had more product we needed to produce. And so we don't want to penalize this department for working those extra hours, 64,500, even though we expected to work only 60,000. The assumption is that we worked those hours because we had a higher demand than we had anticipated. Determine the variable factory overhead controllable variance and the fixed factory overhead volume variance. Enter a favorable. Okay, we already know that. And so let's start with that variable factory overhead, the controllable variance. Let me get my writing tool up here. So the controllable, so this is variable, controllable variance. So we want to start with our actual, run out of space here. You have to skip down a little bit. So our actual variable overhead. It doesn't tell us directly what the actual variable overhead was, but it tells us that we spent $725,000 and that the fixed factory overhead was exactly what we expected to spend, which is the $262,500. So $725,000 of actual spending minus the fixed overhead will give us the actual variable overhead. $462,500. We actually spent $462,500. How much should we have spent? Well, so we know, by the way, compared to our planned volume of 60,000 hours, our spending was higher than it ought to have been. But we actually worked more than that. We know from the concept of variable costs that our costs are going to increase because we worked more hours than we anticipated. So just like we did in the previous exercise, we need to take this variable overhead total, $450,000, and divide by the expected hours to come up with our cost per hour. And that would be $7.50. So when we apply the flexible budget concept, how much should we have spent? we should have spent, based on what we just calculated, knowing that we worked 64,500 hours, and the expected cost is $7.50 per hour. How much should we have spent, or how much did we expect to spend? $483,750. If we had known, when we put together this budget, if we had known we were going to work 64,500 hours, we would have budgeted for $483,750. So the difference, and I'm going to have to put that down here below all of the writing. 462,500 actual spending minus 483,750, the flexible budget. And I got 21,250. And it is a negative. That is a favorable variance. Our spending and we need to use the negative sign. Our spending was $21,250 lower than we would have expected if we had known we were going to work 64,500 hours. We would have budgeted $21,250 more than we actually spent. Does that make sense to everybody? So we spent more than the budget, but we produced more. And we had maybe some efficiency in there. So it didn't, even though we worked more hours, all the costs didn't go up as much as we would have expected. Questions so far? Okay. So let's look at the fixed overhead volume variance. And you might be thinking, why would there be a variance at all? We spent the $262,500 that we expected to spend. Why is there a variance here? Because our full capacity is 75,000 hours. Our full capacity is 75,000 hours. And so even though we worked more than we had planned, we still we weren't as efficient as we possibly could be, because we could have worked up to 75,000 hours. But this seems a little bit counterintuitive based on other conversations we've had in earlier classes, where I have repeatedly said, you shouldn't be producing just because you have capacity. And so I want you to keep that in mind. I am not suggesting through this calculation that the company should have worked 75,000 hours just because they could. But this calculation, the volume variance, takes into account that if we had worked more hours, our cost per hour would actually have gone down, because the assumption is the fixed overhead does not increase just because we work more hours. So I'm just going to do this here because I've got a nice big white space here. So based on our full capacity, not that theoretical capacity, but our practical capacity, what's realistic? We could have worked 75,000 hours. And at that level of production, the fixed, whoops, I need to do that. The fixed factory overhead, 262,500, should remain the same in total. And so our cost per hour then would be only $3.50, whoops, $3.50 per hour. The fact that we only worked 64,500 hours. If we had only spent $3.50 per hour for those 64,500 hours, our spending would have then been $225,750. Compare that to our actual, and I should be putting the actual above it, but I didn't leave myself enough room to do that. So I want to compare that total to our actual fixed overhead, which is $262,500. We spent exactly what we said we would. These are fixed costs. They remain constant, even though we produced less. And as I said, I really should have had the actual on top to do this subtraction. The difference is $36,750. So we need to be very careful how we interpret this. $36,750. We already indicated that that was going to be an unfavorable variance. So we're showing that as a positive value. We have excess capacity we didn't use. That means that we were spreading those fixed costs over fewer units, fewer hours of production in this case. And so that excess capacity, in one sense, cost us $36,750 more than it needed to. We had to soak up, absorb that additional fixed cost on fewer units. And so it increased our cost per unit above where it needed to be. It could have been lower. Again, we need to be very careful with what we take away from this. It does not mean this company should have worked 75,000 hours just to soak up that fixed cost. Remember, that's what we talked about with the difference between absorption costing that we use for GAAP and variable costing. One last comment. We could net these two together to get our total variance. And so the unfavorable variance in their fixed factory overhead volume variance is somewhat compensated for by the favorable, the money we saved in our variable factory overhead, the controllable variance. So netting those together, it's about $15,500. Still unfavorable, but not nearly as dramatic as just letter B shows us there. Any questions on that? We'll keep going then. And so in this exercise, am I seeing the whole thing? Yes. In this exercise, then we're going to be preparing a cost variance report for the factory overhead for the trim department. Tannen Products Incorporated prepared the following factory overhead cost budget for the trim department for July of the current year, during which it expected to use 20,000 hours of production. Excuse me. So they've divided the cost into variable and fixed. Tannen has available 25,000 hours of monthly productive capacity under normal business conditions. During July, the trim department actually used 22,000 hours for production. So we can already see that there's going to be an unfavorable volume variance. They only worked 22,000 hours, but they could have worked 25,000 hours again, we assume they didn't work those hours because they didn't have a need for it to meet demand for their product, whatever it is they're doing. So we're not suggesting they should have worked 25,000 hours. We're just recognizing the cost of that excess capacity. We have our actual costs here for the variable factory overhead costs. And it tells us the actual fixed costs were as budgeted. So just like in the last exercise, this company is spot on with their actual fixed costs. Probably not very realistic, but that calculation of actual compared to budget to find the cost variance or the rate variance, the spending variance for the fixed factory overhead is super easy to do. It's just, what did we say we were going to spend? And what did we actually spend? That's the spending variance for fixed factory overhead. Okay. So we have a bit of a summary here. What are we doing? The monthly capacity was 25,000, but we only used 22,000. We know that the flexible budget, or excuse me, the variable costs are going to be based on the flexible budget. And so we're going to have to change the budgeted numbers we have here into per unit costs. And then, just like we did in the previous exercise, and then recalculate. These numbers that I have highlighted are based on the expected use of 20,000 hours of production. But we know that we actually worked 22,000. So for the variable costs, it's going to be based on the 22,000 hours in the flexible budget. So just like we did before, so that I can scroll down, I'm going to do the per unit calculations up here in the upper right-hand corner. Go ahead and try those on your own as well. Whoops. So now we have those three per unit calculations. We can come down and start completing our factory overhead cost variance report. The actual costs for the variable and fixed costs, we're going to feed in from this information given here, 49,700. Oops. 13,000 for power and light. And 24,000 for indirect materials. So those are given as the actual costs. Total variable costs, 86,700. Now our the budget, we need to recalculate the flexible budget based on the per unit costs up in blue in the upper right-hand corner. So go ahead and do those. Indirect labor, we calculated at $2.30 per hour, and we actually used 22,000 hours. So the flexible budget quantity would be 50,600. And go ahead and do that same calculation. And find the total. And so as we discussed on Tuesday, if we just subtract the budget from the actual costs, it's going to show us the negative or positive as needed. This does still tell us enter a favorable variance as a negative number, but we have separate columns for the favorable and unfavorable variances. So for indirect factory labor, do we have a favorable or an unfavorable variance? We spent less than the budget would have indicated. So that would be favorable, right? We're going to show that as a negative. If you just subtract across actual minus budget, if you get a negative number, that's a favorable variance. So power and light, also a favorable variance. But indirect materials is not a favorable variance. If we net all of those together, 200 minus 1,100, that's a negative $900 or not negative, I shouldn't have said that. That's a $900 unfavorable variance for the variable factory overhead. Everyone good up to this point? We are told that the fixed factory overhead costs were as budgeted. And so we're going to pick up those budgeted numbers from up here at the top of the screen. 54,500 for supervisory salaries, and that's what we actually spent. So no variance, no spending variance there. 40,000 for depreciation. It's what we actually recorded. So no spending variance there. And finally, where is it? Insurance and property taxes, 35,500. No spending variance there. Total, exactly what we expected it to be. $130,000. Find the total actual cost compared to the total budget. The total controllable variances then 2,000 favorable, sorry, 2,000 unfavorable and 1,100 favorable. So because the unfavorable total is higher than the favorable, the net controllable variance is unfavorable, $900. But we know that we have an unfavorable volume variance. This is listed below because as the setup implies, this is not controllable because we only work the hours that we had demand to work. As I said, we're not suggesting they should have worked an extra 3,000 hours just because. And so that's why it's listed down here at the bottom as an unfavorable volume variance, not part of the controllable variance. And so knowing that they could have worked their normal capacity or practical capacity is 25,000 hours. I'm just going to show you the calculation here. Their total fixed factory overhead cost is 130,000, and that's how much they actually spent. So they don't have a spending variance. But that $130,000 could be spread over 25,000 hours. That's their practical capacity. And so that's the minimum cost, I guess, is $5.20 per hour times their idle capacity, which was 3,000 hours. So $5.20 per hour times the 3,000 idle hours is $15,600. When we combine that with the unfavorable controllable variance of 900, the total is 16,500, and that is an unfavorable variance. Whoops. No, can't quite do it. There. So again, we call that, we don't list that with the controllable variance because the capacity, the excess capacity is to a certain extent outside our control, right? We only want to work the hours that we have demand to fill. But we also want to recognize that excess capacity. Any questions on that? Calculations, why we grouped things together the way we did? Anything else? I would say it's a bit unrealistic to think that the actual fixed spending is exactly what was budgeted. Even though these are fixed costs, there usually is going to be some discrepancy. That's some pretty good budgeting. And probably not very realistic. But to calculate that spending variance is pretty straightforward, so. And we would have, if there was a variance, we would have shown right in this section any of those spending variances, difference between actual and budgeted. We have about 9 minutes left and we're on our last exercise, so that's a good thing. So if I take you back to the very beginning of class on Tuesday, when we talked about the use of standard costing, remember we said what that means is the company sets those standards up front. They're going to review those on a regular basis. And those standard costs are what they actually move through their accounting information system, through their records. So think about moving the costs out of materials into work in process, out of work in process into finished goods. When they're sold, they move out of finished goods into cost of goods sold. Standard costing means what's moving through those accounts, like I just described, is what we expected to spend. It's those budgeted amounts. But we can't report on our financial statements what we thought we were going to spend. We have to report actual costs. And so at the end of each period, there's going to be a reconciliation of here's what moved through our system as our standard costs, and here's what we actually spent. And that's what we've been doing in most of these exercises, is calculating what those variances are. We then have to make corrections or adjustments to our accounts so that we are reflecting actual cost. And so that variance analysis really has two parts to it. First, what are the variances? Where did they come from? Who do we report this to, like we talked about on Tuesday? But then the second part is what we're doing here, which is how do these entries actually get made in our accounting records? I have no idea how to pronounce that, what appears to be an Italian word, Cioffi, maybe, don't know. That's how I'm going to pronounce it. Cioffi Manufacturing Company incorporates standards in its accounts and identifies variances at the time the manufacturing costs are incurred. Journalize the entries to record the following transactions. So we purchased 2,450 units of copper tubing on account. So we know that we're going to be reporting this in accounts payable at $52 per unit. So how much did we actually spend? How much do we owe our supplier? 2,450 units of copper tubing at $52. We owe our supplier $127,400. Okay, so that part, nothing new there. You've known how to do that since chapter 2. We owe our supplier. We have to pay our supplier for all the units we bought. And we have to pay the price that was on the invoice, the price that we agreed to pay. However, the standard price is $48.50 per unit. So if we're using standard costing, what we put into that materials account has to be based on the standard of $48.50 for each of those 2,450 units. Into the materials inventory account, we enter $118,825. Actual units times the standard price. And then as we use those materials, we're going to move them into work in process based on the $48.50 that's in that materials inventory account. But again, since chapter 2, you've known how to write a journal entry, and you can look at this hopefully and see that can't be all there is to it. Why not? Because our debits and credits are not equal. So let's find out how far apart they are. Whoops. And they are off. The difference is $8,575. We need another debit of $8,575. What does that represent? Well, it's the difference between what we actually spent and what we expected to spend. So that's $3.50 per unit times 2,450 units. That is our direct materials price variance. We have a $3.50 per unit price variance for those 2,450 units of copper tubing. Everybody good with that? That was pretty easy to calculate that. Now we actually used 1,900 units of that copper tubing. 10 units of copper tubing are required based on the standard to produce one air conditioner. So let me show you this calculation on the screen. The standard is 10 units of copper tubing, and we produce 200 air conditioners. And remember, the standard price was $48.50 per unit. So how much should we have spent for those 200 air conditioners for direct materials? 10 units times 200 air conditioners at $48.50 each. We should have spent, based on our standards, we should have spent $97,000. Everyone okay with where that came from? So because we're using standard costing, that's how much we want to move into work in process and out of the materials inventory. Remember, they went into the materials inventory at $48.50. They need to come out of the materials inventory at $48.50. Oh, whoops. Hang on, I need to make a change there. My apologies. Trying to rush to get this done in the next minutes here. Out of the materials inventory, how many? We actually only used 1,900 units. Forgot about that piece. So we actually only used 1,900 units rather than 2,000. Here we are. Okay, so because we only actually used 1,900 units, we expected to use 2,000, we only used 1,900. The difference between those numbers, whoops. Is $48.50. We need a credit of $48.50 to make this entry balance. What is that $48.50? It's the 100 units that we saved. So we should have used based on the standard, we should have used 2,000 units. We actually used 1,900. We saved the cost of those 100 units. That is a quantity variance. And that is a favorable quantity variance. It's going to partially, at least, offset this unfavorable price variance that we have here. And with 1 minute to spare, we finished. Okay. So there we have the final exercise for chapter 23. You can see the example of using standard costing and what that means, that we move the materials and the direct materials, direct labor, and overhead through the inventory accounts, identifying the variances as we go. So those calculations we've been doing, we really just repeated here in these journal entries. We move it through the accounts based on the standards and identify the variances as we go. And so at the end of the period, at the end of the year, the month of the quarter, whatever, we're able to just run a report and see how much did we have in total for direct materials quantity, price variance, how much did we have for direct labor quantity, price variance, what were our overhead variances, and there's our analysis. And then the hard part begins, which is, why are these different? What are these numbers material? What do they mean? Who do we tell? How do we fix this if they're unfavorable? How do we make it keep happening if they're favorable variances? Okay, that's the end of chapter 23. Any questions, concerns?
So you said these are gonna be made available today.
Yep, as soon as I get back over to my office, I will update actually, I'll probably just do it right now. I'll update the sample projects for the on-campus class. The ones in the online class are already there, but I'll update the on-campus ones right now. Anything else?